At the beginning of our conversations, you mentioned China coming a little bit back in terms of their growth momentum. How do you see, as one of the biggest investors globally, the Chinese market in general and also the emerging markets going forward, perhaps also including what's happening on the quantitative easing side in terms of the Fed and the ECB and what that actually means for emerging markets?
Well, that's an ambitious question and requires a very long answer, which I think will be a little tough for the people who are listening. To make it easier, I think that the Chinese economy is going through a period of readjustment. President Xi has indicated he wants to change the economic balance from an export economy to one of more internal consumption. Part of the reason that the Chinese want to do that is because their objective in their economy is twofold. One is to put their people to work, but the second is to make sure their people become more affluent. China, which people in the West regard as a rich country, actually, depending upon how you measure it, is between the 90th and 100th poorest country in the world of per capita income. So what they want to do is make their people have more money and have a better life. It's a reasonable objective. When you do that, you can't be a low-cost manufacturer. You don't have cheap labor. So they're actually trying to get rid of their cheap labor, which creates a real problem for them conceptually. And the solution is to have more of a services economy. When you go through that kind of change, it puts a lot of pressure on an economy. The Chinese also are great savers, so getting them to spend is a little hard because they don't have the safety net, ironically, that you have in the West. So I think there's more of a bias over time to the downside in terms of earnings growth in China as they go through this transition. When they come out of it, they'll be in much better shape. If China is slowing down at all, it has a boomerang effect all through the emerging markets because a lot of the emerging markets have done well selling commodity goods to China. So those economies really have more of a linkage than people think. And so the time of the boom times, the ever-growing times, the unbelievably optimistic time of emerging markets has sort of passed in this cycle. That doesn't mean they won't continue to grow at higher rates than the developed world. It just means there'll be an overall adjustment, which I think most people expect. But world GDP is going to do okay, and so we're not at enormous risk, in my view.